All right, welcome to today's video. I know this is a sort of different format that we used to do, but I figured I would focus more on the quality of information presented over the quality of production and complexity of production. That being said, welcome to Offside Capital. If you guys know me from Investor Brew, we've switched brands. This is a more premium sort of research publication. And I hope that today's video gives you a sort of taste as of what this is going to be moving forward. In today's video, we're going to talk about a very important divergence and break between the hyperscalers and the semiconductor memory stocks, right? So historically, these have been pegged together in price action and correlations for both economic and statistical reasons. Now, ever since 2023, things have changed, and over the past quarter, this peg has broken, and I think it's the main trigger that people should be watching out for when it comes to the AI trade and everything that's going to happen moving forward. This pertains to companies like Amazon, Nvidia, Google, and a bunch of others that could be affected by what's happening right now. So that being said, let's get into it. Uh, and for this one, there's one spread that tells you everything you need to know about the AI trade. And first of all, the signal is the semiconductor stocks and hyperscalers, which have been 96% correlated over the history, and they just opened the widest gap since 2022. If you remember, that's when we had the last proper bear market and the last proper call for a recession in the US economy. So since March of this year, the semis are up 86% roughly, while hyperscalers are pretty much flat to negative now, turning into this week and the rotation that we had last week. So the read about this spread, what's happening here, what you should take away from this divergence is that when the semis lead the divergence and lead the spread, the outcome has been historically bullish for the S&P. And semis are leading right now. So why is it bullish? We're going to get into that in a minute. But basically, semis are more cyclical. They're more capital intensive. They're more capital related to the credit cycle and the risk appetite cycle. There's a nuance, though, to this spread happening this time around. So after 2023, this is when I say that things changed. Since capex is now driving these chips, capex didn't used to be a thing. It wasn't a thing before 2023. It was just how much cloud usage are you performing when you're in Amazon or Google or Microsoft. Now it's more about how much capital can you invest into the build out of AI and all the infrastructure that's needed, right? As of post 2023, every 10% increment in Amazon capex could map out to towards 12 and a half, 13% in incremented NVIDIA cells, right? So that relationship didn't exist before 2023, and it does now. And I think it's very important for you to keep in mind and keep track of. So that's what we're going to cover today as well. Uh, After that, there's going to be one trade. There's one corner of the market that wins whether AI succeeds or fails. And I think that's going to be software, right? Select hyperscalers like Meta, like Microsoft, the ones that are in a bear market for no apparent reason. They're still posting strong earnings, strong growth metrics, and margins. Nothing that suggests that AI is going to be disrupting them, as well as software, right? So you have companies like Adobe. We did a whole deep dive on it. I'll link to it in the description below. But essentially, companies like Adobe, Workday, ServiceNow, they're not seeing any AI disruption. Otherwise, you'd see it in margins, in AI first revenue slowdowns, losing market share, etc. Right? We're not seeing any of that. So that's why I think select hyperscalers and some software names are going to be the corner of the market that wins whether AI succeeds or not. So now let's get into the juice of the video today, which is the spread between hyperscalers and semis. So you know the importance of it. Historically they have been correlated and they're breaking now. And I've made a semiconductor and a hyperscaler basket. The details of it will be posted in a newsletter coming up, so make sure you check it out in the link below. But basically, the index since the first quarter of this year has gone 86% higher for the semis in dark blue, and then pretty much flat to almost turning negative for the hyperscalers. And the takeaway is that the semis are pricing in the cash flow that's happening today from the capex, while hyperscalers are pricing in an uncertain future return from AI. So that narrative, that factor exposure matters a lot when you build your portfolio and you start to look into the situation for AI today. And we're going to explain what that means in a minute too. But for now, just know that correlations over the past decade have been averaging around 90%. You can see that in the red trend line. And every time they break down, so we had one in late 2016, early 2017. Then we had another one in late 2017, early 2018. And then little the blips along the way. And then the big one in 2022 when we had the services recession in the US in the, like I said, the last proper bear market. And then we had one in 2024 when Opus was announced from Anthropic and Claude was released, and there was another disruption between hyperscalers, cloud computers, and the AI semiconductor names, right? So this 2022 was also when ChatGPT was released. So again, every time AI and semi-related names do something, they break their peg to hyperscalers. And before 2023, this used to happen on an economic basis, right? So defensive versus cyclical rotations. And the fact that we're diverging from this today, like we saw in the previous slide, is going to lead to another breakdown in the correlation. I think it's too soon since these are 1 year and 2 year rolling correlations. But that quarterly break that we just saw is going to show up in these correlations. But the one thing you should know is that every time they break, they tend to snap back within a quarter or two. So whatever's happening right now, I think is going to end by September. And I think either hyperscalers are going to rise up to match the semis, or semis are going to come down to match the hyperscalers. So that's the two different outcomes that we're going to explore later today as well. But just know that it's going to happen within the next quarter. Historically, it needs to happen, right? So there's two sides to this trade, and two sides really to the divergence that we're seeing in the spread. And it's on the one side you have the check writers, right? So Amazon, Microsoft, Meta, Alphabet. These guys are writing the big $1 trillion checks to build out the AI infrastructure, right? So the returns on that investment, they used to be timed out at the beginning, let's say 5 years out. And this is when management and CFOs expected to see a positive ROI out of the $1 trillion checks that they're writing. The issue is that based on that economic investment, and the fact that token prices are coming off, the fact that companies like Uber, like Meta, Google, Amazon, they're all spending less on AI because they're figuring out that the return on productivity isn't there yet. So what happens when you invest $1 trillion and you expect that AI investment to return within 5 years? Let's say, I don't know, 10%, 20%. I don't know what the numbers are, but put yourself in their shoes, right? What happens when AI starts making less revenue and that return on investment gets pushed out further into the future and becomes more uncertain? Well, you have a free cash flow and earnings and a margin uncertainty that is starting to get priced into the stocks, right? So these are lagging. The check writers, the hyperscalers are lagging indicators of what the market expects will happen in the AI trade. So the fact that they're lagging tells me that there's increased uncertainty around the return on investment from all these $1 trillion checks. Then on the other side, you have the check receivers. So these are the semis, the memory stocks like Nvidia, Micron, SK Hynix in South Korea, Broadcom, Samsung, you name it, right? So these guys collect the money that is being written in the checks from the hyperscalers, along with energy names and basic materials, industrials, and all that. But I think these are the main beneficiaries from all that capex, right? And these are the leading names because they receive the revenue, they book the revenue first in the whole capex creating demand circle of financing that we could cover in another video. Uh, but the fact that the semis are leading tells me that the market now prefers the certainty of cash flow that happens today rather than the uncertainty of these cash flows that is becoming more blurred out in the hyperscalers based on the level of AI revenue. So now I hope you have the picture that's painted by the market. They're bidding semis and they're selling hyperscalers. So they're preferring certainty today and they're selling off or they're hedging the risk of uncertainty in the future, which should tell you that nobody's sure of what's going to happen in the AI trade anymore. They used to be, but now the spread between these two is widening. So that should tell you something. And what it should tell you is actually very well quantified in the number that everybody is watching, right? Every bull cites the $7 trillion capex, but I think they're watching the wrong number. I think that what you should be watching is that out of these 7 trillion, already 3 trillion plus, and I think it's going to be upwards of 5 trillion by the time 2026 is over at the current pace, right? So let's just call it 3. $3 trillion committed and only 200 billion of annual recurring revenue is being generated between Gemini, Copilot, ChatGPT, and Claude. So there's roughly a 15x gap between commitments and revenue. So this is the number that I would watch, guys. I don't think that further capex is going to fix this. I don't think that further financing is going to fix this. I think revenue needs to start showing up, right? Otherwise, how do you close that 15 times gap? And the reality behind this gap is that you and I, I'm a power user in AI. Claude built this presentation for me based on research and voice notes that I gave it. Uh, but I only pay like $50 a month, and I pay $20 a month for ChatGPT. Users like you and I are not going to close that gap. We're not going to generate trillions of dollars in revenue. The only thing that can close the gap is enterprise revenue, right? So, enterprise software, corporations that need to pay for AI to automate workflows, to have the agents working 24/7, like Claude, Cowork, and all that sort of stuff. So then that brings me to the beginning, the trade that wins no matter what happens to AI. And I think it's software, right? Because software is going to become the toll booth in the AI trade to close down the 15 times gap between commitments and revenue. Otherwise, who's going to do it, right? Medium-sized businesses, they're not going to do it. It has to be enterprise. Now, I think that brings the entire trade, the whole AI economy, the whole AI trade into a single bottleneck. And it's not energy, guys. I know that everybody's been covering the energy trade and the energy bottleneck. I do think that's a thing, but it's already priced in. I mean, you look at the price action in energy and basic materials and industrials, and I think the expectations are already built in for the revenues and backlogs of demand that are going to see from the AI build out. So what is the next bottleneck? And I think it's in the application layer, in the software layer, right? The physical world, the actual workflows layer. And like I said, you have $7 trillion committed, out of which 3 trillion have already been out. You only have 200 billion in ARR generated. So who fills the gap? And that is the main question, the main bottleneck that we're trying to answer. And again, I think the best candidate is going to be software here. So let's go back to the spread and the correlations between the hyperscalers and the semi memory names. So before 2023, that's what you see in the scatter plot towards the left side. This is the NVIDIA revenues on on the vertical, NVIDIA revenue growth, and then you have Amazon capex growth on the horizontal, right? So it used to be roughly, you had 10% growth in capex and then 20% growth in NVIDIA revenues, etc. And what you see toward the right side of the scatter plot is that we now see 60% growth in capex and then 100% growth in revenue. So roughly, there's a 50% correlation seen by the squared R statistic, right? And every 10% growth in Amazon capex could increase NVIDIA revenues, NVIDIA sales by 12 to 15%. So this didn't used to happen before 2023. In fact, this relationship only started happening post 2023, and this is only Amazon to Nvidia. We haven't checked Microsoft to, I don't know, Micron, or I don't know, Samsung to Google, right? But I believe that relationship stands across the entire industry But this is just Amazon to Nvidia, and you can see how codependent these two have become. So, in other words, Amazon should be moving with Nvidia. Amazon should be moving with the semis. But as of right now, and we've checked this already, the hyperscalers are breaking the peg to the semis in memory, even though the hyperscaler capex is codependent with the price action, with the revenue in the semis. So this is breaking, right? This economic and fundamental relationship is starting to break. So either capex are becoming less of a thing, uh, or is becoming more uncertain, right? Because it cannot justify further trillion-dollar checks. This is some of the outcomes that we're going to cover in just a minute. But this time, and when I say this time, I mean the spread, the widening spread, the breaking peg between hyperscalers and semi-memory names. This time isn't about the economy because before 2023, it used to be the capital cycle, the credit cycle, the risk appetite cycle. But now it's a bet on AI itself. And on one side, you have the market betting that AI works, which is why they're bidding the chips. They're bidding the chips, both semis and memory, because it's a bet on sales and cash flow happening right now from all the demand, from all the capex that's coming from the hyperscalers, right? So on the other side, you have to hedge the risk, right? And we already know that for every dollar that gets put into the semi trade, roughly 30 cents go short into the software trade because of the AI will kill software narrative, right? But I don't think that's going to happen. And you're starting to get the logic behind that, but we'll dive into it further in just a minute. So on the other side, we're selling the hyperscalers apart from selling software. Why? Because the market thinks, well, what happens if AI doesn't work? Well, we have to preserve our capital, we have to preserve logic, we have to preserve expectations. And because the AI trade is starting to fail, and when I say fail, I don't mean AI will fail. I mean the revenues that were expected are starting to fail. Those expectations are failing. So we have to start deleveraging, de-risking the book when it comes to the names that will be affected by this blurred out, by this pushed out timeline on return. And that is the hyperscalers. So when we move forward, there's another trend happening across the world, and this is in South Korea. So South Korea suddenly became correlated to the Nasdaq, right? The Kospi and the Nasdaq. And economically, these two have been correlated when it comes to the PMI. So Korean PMI manufacturing turns before the US manufacturing because we have such a high exposure to their semis and memory chips exports. But now it's become a stock market phenomenon, right? So the Kospi, you've seen it recently, goes down 10%, up 10% in a single day, and then it affects all the memory names and all the semi names in the US, specifically the NASDAQ, right? But that's a topic for another day. I am making a newsletter for this. It's going to come out probably by the time you watch this. Today's Monday, and it's like 9 a.m. right now. So, yeah, probably later today, by the time you watch this, it's going to be out. So, I suggest you go check it out and understand how and why South Korea is affecting the US stock market. I'll link it somewhere below as well. Otherwise, go check our Beehive page for Offsite Capital. Now, let's go back to the markets here in the US, right? And this is the highest valuation that we've seen throughout previous bubbles, right? So we have 1929, 33 on the Cape, 2000 bubble, 44 on the Cape, 2021, post-COVID, right? That led to the 2022 bear market, 39. Right now we're at 42.3 on the Cape ratio. So again, it's an overvalued market, and I'm not the only one saying this. There's a lot of respectable investors that agree with this point. But let's compare what's happening today to previous sort of bubbles in the market, right? And we've seen this leverage and belief setup before. This is no different. We had the lost decade in Japan, late 1980s. Then we have the great financial crisis, and then we have right now. So in both Japan and the great financial crisis, we had the belief that stocks or other assets like property only go up. So you're free to take on leverage, you're free to take on massive bets because the asset that you're betting on only goes up. Whenever that happens, there tend to be bubbles, right? So what I would say here is, we're starting to look a lot similar to previous bubbles, and I'm not even getting into the accounting shenanigans that's happening behind NVIDIA and the 300 plus entities that NVIDIA has invested into. At this point, and I'll just give you a primer, over half of NVIDIA's balance sheet is made up of equity stakes in other companies. And that's another deep dive that we made for the AI trade. Feel free to check it out. It's in our website for Beehive. But anyway, we are in a sort of bubble, and that's undeniable. Anyone that tells you we're not in a bubble, it's, God help them. But so far, we haven't seen capitulation. We have seen a rotation out of tech and into real economy names, defensives, like healthcare, industrials, basic materials, but we haven't seen capitulation. So this may not be a bubble that pops so abruptly as it has in the past. It may just be deflating at this point, but something to watch out for. Now, uh, back to the gap between hyperscalers and semis memory stocks, right? There's three ways that I think the gap is going to close and three different meanings. So in the first scenario, you have the hypers rising to meet the chips and memory price action. I think that only happens if the hyperscalers cut the capex, which would lift and normalize their free cash flow, uh, earnings as well, of course, and valuation. So that would signal as well a rotation, a further rotation from growth oriented and speculation oriented stocks into defensive and quality preference in the market. Historically and logically, that would be bearish for the S&P. And I'm not saying it's going to be bearish in a sort of crash and bear market way, but definitely like a 10-15% correction could be overdue in that sort of scenario. The second scenario, I think the chips could fall to meet the hypers. Historically, this is mixed, depending on why this is happening, right? So I think that if memory or semis fall on oversupply, or the same uncertainty around AI revenue starts to hit them, we could see a sort of bearish scenario. But if it's happening because the hyperscalers are rising or the hyperscalers are flat, then that could be another scenario. It could be mixed because breadth and smaller caps could start to shine again. And that would be bullish to the S&P post a 10-15% correction, allowing for that rotation. So something to watch out for here as a second scenario. And then third, I think hypers could rise and the chips sell off, right? So instead of both meeting each other, one rises, the other one sells off, and they cross back over, which would again break the peg in the opposite way that is happening right now. And that would be the major risk off because that means there's no more growth expectations going into semis. So they're going to cross below the hyperscaler basket. That would mean capex ends, and that creates EPS or earnings per share uncertainty for these semis. And of course, these semis and memory names lose the new orders. The AI trade effectively ends. I think the only way that it ends is if the semis memory basket crosses below the hyperscaler basket, and you have the combination of ending the capex. So that would be the most aggressive risk off scenario in my view. I am personally betting on the middle one, so the scenario number two, right? We have the chips fall and hyperscalers stay flat or slight uptrend, and I think that would create a sort of deflation of the speculation that's happening right now and a further rotation into real economy defensive names. So again, it's just a bet that we're putting on, and there's specific portfolios for this. We actually give you our portfolio every single morning in the morning digest, so make sure you subscribe to the free newsletter below. But now let's go back to the meaning of everything, right? So if semis are leading, history says that's the bullish tell. And when semis lead, it's bullish for the S&P, bullish for the economy, for the reason that chips, like I said before, they are more cyclical. They require more risk taking, more capital cycle appetite. And that's the current setup. So either we're going to see a reversal in the S&P and maybe hit new all-time highs, as long as the hyperscaler basket stays lagging to the semi and memory basket, right? But the reasons why that is being created matter. And we can go back to the three scenarios before and watch what happens here. But so far, I think it's a bullish setup for the S&P. What I would watch out for is that if the spread starts to close down, and is being led by the hyperscalers. That would be the bear scenario because hyperscalers are historically defensive. They're more stable names. They don't require as much risk taking or capital intensity from the cycle and credit. So again, right now, bullish setup. If we start to see more volatility out of South Korea, out of Micron, further lagging out of Nvidia, it could trickle down into the entire semi and memory basket. But again, it's too early to tell at this point, in my view. And what I want to leave you with from all this is, try to own the basket that wins in both scenarios. And I think that's going to be software, right? So you have the toll booth that I mentioned earlier, closing the gap between commitments and revenue. And software, if AI succeeds, well, software, in order to survive, they have to adopt AI. And adopting AI means further market share, it means further margin gains, it means further efficiency. So again, AI succeeds, it has to be adopted by software, software wins, right? If AI fails, then the AI will kill software narrative dies as well. So then we have a recovery in software. So I mean, I like to make bets where if I win big, and if I lose, I still win, but I win small, right? And I think software is one of them. I mean, AI succeeds, like I said, they have to close the gap to revenues. I think software, enterprise software is going to be the one to do it. And then again, in order for it to survive, software has to adopt AI. So whichever way you look at it, I think software wins. AI wins, AI fails, software will be the winner here. And then a secondary bet that we're looking to make is in select hyperscalers, right? So we're starting to see in the basket that the uncertainty around capex is dragging all of these names down. So what names have all of this already priced in? I think Microsoft and Meta, they're in a deep bear market. Their future expectations are way too bearish. I think they're getting pretty easy to beat in future quarterly announcements. And I think that's a pretty good setup. I mean, buy Microsoft, buy Meta could be one of the plays in the portfolio. We already own Microsoft, we already own Workday and Adobe. So this is my sort of win-win scenario for the AI trade. And feel free to check it out. Like I said, we send out the portfolio in every. All right, so now what would make me change my mind on this entire thesis? And these are the signposts that I would keep a close eye on when it comes to the next quarter or two of earnings releases. So first, the spread, right? We have to see whether the semis keep leading and widening the spread, or whether the hyperscaler basket begins to catch a bid and match the price action on the semis and memory, right? If they cancel the capex and then whatever basket starts to lead or lag, that's a big tell for what's happening underneath. Second, and just as important, is the capex commentary. So we have earnings season coming up in the next following weeks. When these hyperscalers give out the actual capex number and the capex guidance for the future, that could pretty much change the entire thing and the entire setup for the AI trade. So again, I would watch out for capex guidance, free cash flow activity, and if there's any free cash flow, financing through bond markets or stock issuance to keep funding the capex. And because it's not just about how much capex is being done, but how is that capex being done. I think that tells you a lot more as well. Now, chip orders versus prices is something that is starting to show up in companies like Supermicro, Micron, Samsung, SK Hynix, and etc. Right? We have a divergence between what's being said and what the numbers actually say. So if you look at the balance sheet and the cash flow statements for Micron in the recent earnings, we posted about this too in the free version of the newsletter if you want to get deeper into it. But we essentially had a big spike in revenues. I think it was like 86% and a further guidance higher. Yet inventories are not changing quarter to quarter. So what this tells me is that, there's two ways to increase revenue. One is volume, the other is pricing. So we're not having a volume increase in sales of chips, but rather we're having an increase in the price of memory chips. And you can see it in Microsoft and Apple saying they're going to raise the price of hardware because of memory chip pricing. So this isn't a volume thing, it's a price thing. And whenever market forces stabilize, that could get wiped out in a minute, right? So The other one would be inflation, and this is tied to the pricing dynamic that I just mentioned. So we have PCE at 4.1, double the Fed target, of course, and AI related commodities driving the PPI higher when you take out energy. So all this tells me that there could be an increased risk of a spike in future interest rates, and that could, of course, place a headwind when it comes to capex financing, debt financing, and the further AI build out, right? So something to watch out for. Korean PMIs, like I said, by the time you watch this, there's probably going to be a newsletter deep dive on the Korean situation. And I could also make an extended video like this one on the entire Korean betting situation. There's a lot of leverage going on there, guys. There's probably like $1.5 trillion using US equity collateral that could get wiped out. And I mean, you're seeing it now. You see the Kospi swinging 10% a day, and that leads into the Nasdaq price action. So, whatever happens there, as far as risking and de-risking the books for individual investors and prime brokers, could have a contagion effect on the U.S. And then the IPOs. I mean, this is a wider issue, and we could get into it as well in another video. But we're essentially going to have the largest supply of equity coming into the markets in history, right? So demand supply, guys. And we just had the SpaceX IPO. It was a success for the first week, and it's now starting to pull back. I think there's a reason why OpenAI and Anthropic are delaying their IPOs to next year. I think it has to do with exactly what we're talking about here, the spread caused by the uncertainty of AI revenues. So whatever the reason, if this is due to the uncertainty on revenues, I think it would be smart from management to delay these IPOs because they don't want you to see the mess that's happening inside these companies, the loss of customers, the loss of ARR projections. So again, this is a wider issue that I would ask you to keep in mind. And that brings me to the end of the video. New format, I know. Let me know what you think. If this is enough or you want something that's more high production. But I think this is something that you should keep in mind. Go read the newsletter version of this. There's going to be a lot more charts and a lot more decision-making facts. But for now, watch out for the hyperscalers and the semis basket divergence. This happens every cycle, but this time in 2026 is a lot different because capex is the new driver. Previous to 2023, this wasn't a thing, as you know. But whatever happens, I mean, I don't have a crystal ball, right? The only thing that makes sense to me is bet on a way that, works out in both ways, whether AI succeeds or not. And that's going to be software. So, yeah, keep an eye out on our portfolio. It comes out every morning. The morning digest, Monday to Friday, in a free version of the newsletter. Thank you for watching, and I'll catch you guys in the next one.